To both of you. Michael, you characterize yourself as relatively more cautious than maybe you typically are. Explain why.
Funny, Tyler, I always think I'm relatively more cautious than everybody most of the time. But when statistically we're supposed to go into a recession this year and earnings are supposed to go through a contraction, it's hard to be, let's go all cash. And you certainly don't want to be in the thin branches of risk right now. So lots of things gearing up against us. But I think there's still opportunities longer term in those companies with good balance sheets and good cash flow and things, too, that have been beaten up that you can, I think, probably continue to buy. But being really aggressive in here, I think caution is probably warranted.
Ron, we heard earlier some sort of back and forth about the Fed and whether we should believe what they're saying. They said pretty clearly in those minutes there is not going to be any interest rate relief coming in 2023. Should we believe that?
Well, I don't know, Tyler. You know how I feel about all this. I mean, we're getting more and more data that comports with the position I've had for quite a number of months now, that inflation peaked in June. We're seeing weakness in the service sector. We'll look at the employment cost index and CPI in coming weeks to find out whether or not we get confirmation of that. And we could be heading toward a recession. It's very rare that you have a yield curve as inverted as this one. Service sector, manufacturing sector showing signs of weakness, and the real estate market in a complete recession without getting a general recession somewhere down the road. One would suspect they would respond to those conditions if and when they occur. But look, I'll take the Fed.
But would it be a pivot or a pause? Would it be a pivot or a pause?
Well, I think first a pause and then a pivot. And I think that's critical going forward. I mean, I think we're going to need a couple of P's to happen this year. Pandemic's going to have to completely go away in China, or that's going to have to work out some way advantageous to Chinese economy. Profit recession, if it occurs, is problematic. A pivot's going to be required. And Leon Cooperman this morning with our colleagues mentioned looking for a new bull market in this environment without help from the Fed might be a mistaken way to look at this year.
How do we figure in, Michael Farr, the fact that the Fed is not only tightening rates, but unloading content off its balance sheet, and what that will mean?
Well, I think they're doing exactly what they're doing what they said they were going to do, Tyler. They're tightening monetary conditions. And for the past 10 or 15 years, the Fed has been our backup. The facts here as investors in the markets, things would get tight, the Fed would cut rates, stock prices. They've completely changed that role. So they're the ones who are doing the tightening. I think they're going to do it not only on the balance sheet, but continue to do it on rates. Will they go too far? Yes, they'll probably go too far. But to the question you asked, Ron, will they really stick it out through the end of the year? Probably, but maybe not. If they get things wrong enough, if we have some other exogenous shock, they may have no choice but to actually stop and pivot. I'm figuring that Jay Powell's going to do what he says he's going to do and stick with this rate hikes and probably get quiet and leave the cost of money high for the balance of the year. And I think we've got to see an uptick in unemployment. Until you see unemployment north of 5%, you typically see wage inflation higher than CPI. They need to equal out, kind of.